Today, I am going to talk about the biggest mortgage myth that you have been told, which is to pay off your debt early. I won't do that, and in this video, I'm going to share with you why. So I think first of all, we have to think about why majority of the people thinks about clearing off their mortgage loan. So I think there are multiple reasons for this. Likelihood, it might be influence from your parents, which in their era, they are always taught to pay off all debt, have no debt in their name. The second point, it might be a personal goal. So some people might think that, oh, my goal is to clear off my loan as soon as possible. So they might make it a mission to clear off their loan. The third thing, it might be status. Being very proud to tell your friends, oh, I have cleared off my loan and I'm actually ready for retirement. So before I dive into the reasons why I chose not to pay off a housing loan and I advise my clients to do the same, we shall discuss with regards to the pros of paying off your loan early first. So I think number one, if you are able to pay off your loan early, the very straightforward benefit is you get to save on the interest paid. Especially right now, I think interest rate is at a very high rate and majority of people who are on the mortgage can start to really feel the pain. And using an example, if you're getting a 1 million loan with 30 years tenure, at a 4% rate, you actually paid off about 700 over 1,000 worth of interest in the 30 years period, which is quite a huge sum of money. The second benefit is, once you clear off your loan, you can have a peace of mind, knowing that your shelter is secured, you do not have to worry about your debts. Or the third point is, you might want to purchase another property, and paying off your existing loan allow you to take a higher loan for your second property. So how about the downside of paying off your loan early? So I think it's very important to learn to read between the lines. Even though I've stated all the benefits in the earlier segment, these are some additional pointers that I want to share with you so that you can make the best decision for yourself. So the first downside of paying off your loan early is that for every dollar that you pay towards your mortgage, all your money is locked in your property. So if you think back about how are you going to extract liquidity out of your house? There's only two ways that you can do it. The first way is you either rent your house in terms of renting some rooms out or rent your house out, but you have to think about where you want to stay. Or if you sell your property. So if you're not going to do the two of these methods that I mentioned, likelihood all your funds that you have paid towards your mortgage is locked in your property. So I like to use this analogy. Imagine you are just sleeping on your cash. Hence, paying off your mortgage loan early means that all your cash are locked into your property and you're just sleeping on all your cash. And the second point, you have to understand opportunity costs. Using these two examples of a 1 million loan, 30 years tenor, assuming let's say a client decided to just pay off early by another 200,000, the mortgage differences itself wouldn't be drastic. So you can look at these two examples here. Mortgage payment went from 4,700 plus to 3,800 plus. So you would save about 900 plus per month in terms of the monthly installment. And of course, through the tenure of time, if you decided to pay off early for the 200,000, you actually do save quite a bit in terms of interest. So the total interest paid, as you can see in this example, went from 718,000 to 574,000. So that would save you about 143,000 odd. It seems a significant amount at first. But what if you are able to actually channel these funds into an investment? So let's not talk about investing it into stock market or anything. We'll just put the funds itself into a special account or something that generate 4%, which can easily be done in this current market condition. The 200,000 itself through the 30 years period of time would have ended up to becoming 648,000. So think about it. Would you want to save 143,000 or would you want to gain a benefit of 448,000, which is 668,000 minus off your capital of 200,000? Holding liquidity in your hand while at the same time enjoying a beautiful rate of return. And the third point is likelihood when you have purchased the property, if you are financially savvy, you would have purchased a mortgage insurance on your property. And taking that into calculation, if one of the payer of the property, let's assume a husband and wife, either one touch wood pass on, having the mortgage insurance give you a clean slate, meaning the insurance itself will come in to pay off all the mortgage. Then if that's the case, which is the worst case scenario, but in the situation, why would you want to pay off your loan when the insurance is covering your mortgage if any mishap happens? So if you are planning to retire early, small things like this can affect how soon you can retire. The idea itself is knowing how to make your money work for you and making every dollar work. And they should be in the right place. Here are 3 actionable things that you can take away from this video. First of all, avoid making any partial prepayment to pay off your loan earlier. It does not benefit you in the long run. if you have seen what I've shared with you earlier. Second thing, don't be a hero. If you are going to borrow from the bank, maximize your loan, maximize the tenor, and for the property that you want to purchase, borrow to the maximum quantum, which is likely 75% of the property prices, taking into consideration your income and age. And talking about this, I would like to share with you one story that happened to one of my clients. So one of my clients, when she is taking the loan, her first loan, she minimized the tenor to such a short number of years to ensure that she can pay off her loan early. But however, this led to a monthly installment becoming crazily high. So during that period of time, it's so hard for her to go travel or have the disposable income to enjoy her life because she is so concerned regarding about her monthly mortgage that majority of the disposable income is given back to the mortgage. So when I met her and did a review, I told her to maximize the loan so that she can drastically reduce the monthly installment, enjoying good lifestyle, but at the same time making all her rest of the money work for her through investments so that she can prepare for retirement, which makes a lot of sense. She's so much happier after doing the restructuring. And the last point, do ensure that you get your mortgage insurance. And in my career of 11 years in the financial planning space, I saw situations where mortgage insurance are paid out and cleared off the mortgage loan, which allow the family to be able to have disposable income for their own use, but at the same time, the mortgage insurance took care of the remaining debt itself. So this is something that is very important to your portfolio that if you have not considered it yet, do find out more and add a mortgage insurance into your portfolio. So I hope this video has been beneficial to you. If you find this video helpful, share it with others who might benefit from this video. And if you're keen on leveling up your money knowledge, do remember to click the like, subscribe, and notification bell. I will see you in the next video.